Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Dennis Dick, and we have Kevin McPartland on the line. He is principal of market structure and technology at Greenwich Associates. Kevin, how you doing this morning?
Great. How are you?
I'm doing good.
Kevin, got a question for you here. Did you get a chance to read that Wall Street Journal article yesterday from Bradley Hope about John Doe manipulating Treasury futures? Did you get a chance to read that?
Yeah. No, it's certainly something that's been sort of floating around in the background there for a while. Both sort of the Treasury market in general, both from the future side and even in the underlying bonds.
So just for our listeners here, there's a Wall Street Journal article yesterday, and it's actually a high-frequency trading firm. Kind of, they're saying it's like HFT versus HFT. I'm a little skeptical on that, but HFT Capital Partners, or HTG Capital Partners, filed a federal lawsuit earlier this week with unnamed spoofers, which the suit refers to as John Doe, in the hopes of getting a judge, just reading this from the Wall Street Journal article, to force the Chicago Mercantile Exchange to reveal names of firms. So they're accusing these firms of potentially spoofing the Treasury markets here, where they're putting in quotations, so fake quotes, to get other participants to possibly join them or to bid higher, and then turn around and smack the bids. What's your thought here, first of all, on this article? They've outlined it pretty interesting. I'll post the link in the chat here because it's some very interesting charts and stuff. But what are your thoughts, first of all, on this specific case, and then what are your thoughts on spoofing?
Yeah, I mean, so it's a pretty interesting situation, right? So, HTG, right? I mean, they're sort of by definition, you could easily call them a high-frequency trading firm as well. But I think one of the things that this highlights, right, and we talk about, quote unquote high-frequency trading in a single breath, as if all the firms are doing the exact same strategy. When in reality, HFT is not a strategy in and of itself, right? It's a I guess a style of trading, if you will, that has many underlying strategies.
Very
So,
quick style.
this is a great case where, this is a great case where we're showing that, clearly, or at least in my head, most of the major, proprietary trading firms, whether it be in the Treasury futures market, the bond market, the equities market, right? These are mostly good apples, right? They have legitimate strategies. That sort of they've worked at that often is either providing liquidity to the market or in some cases taking liquidity from the market. And they also are frustrated with folks that they feel aren't sort of following the rules, whether the rules are explicit rules or implicit rules. And that seems to be what we're going after here, right? It's sort of the bad analogy, the one bad apple spoils the bunch, and I think that's what often happens to that big umbrella of high-frequency trading. Now,
But
sorry, go ahead.
I was going to say, there's already rules set against spoofing. There's already rules set against, they even layering. You can kind of all tie this all into this. It's basically just putting fake quotes out there. So if you don't know what spoofing is, it's just basically putting fake bids out there, and they're real bids, so the bid is actually hittable, but they're putting them out there with the intentions of quickly canceling those, like trying to change what it really looks like, what the market currently looks like, trying to make it look like there's a little bit more supply or a little bit more demand, and trying to turn around and sell the other way. So let's say, for example, in this case, they were bidding Treasury futures when they actually wanted to sell them. So they're bidding it, hoping somebody joins their bid, and then they turn around and smack the bid.
Yeah, no, that's right. I mean, really, in its simplest form, it's market manipulation. It's just happening very quickly and in very minute increments. There's actually been other reports in the news, and this is something that we at Greenwich have been looking at quite a bit over the last couple of months. Is sort of the related to the Treasury futures market is the market for actual for U.S. Treasury bonds, right? And we often don't think of the bond market as a place for high frequency trading firms, but increasingly it is. They're a major presence in the underlying Treasury market as well. And what's interesting and to me quite ironic, we're talking about U.S. government debt here, right? So this is coming from the U.S. government, yet there's really not a lot of rules and requirements around how you trade and what you're allowed to do in those markets. Even if we talk, and I'm sure you guys have talked about Volcker over time, right? That keeps banks from doing proprietary trading. Government debt's excluded from Volcker, right? So you can still have the major banks involved in these markets, some of their quantitative trading group. So it's a really interesting dynamic in how the futures market here plays off the underlying treasury market, and there's just a lot of sort of high-speed trading activity there. And we've talked about this before, but in a lot of cases, I think, and this goes back to the original conversation we're having about this case, is that for the most part, these are firms that are providing liquidity to these markets, especially in places where the major banks are being forced to back away a little bit because the cost of capital has been high, and they're just, obviously it's been a tough market for the last couple of years for the major banks for a variety of reasons.
Just staying with the spoofing, this has always existed, though, Kevin, and I know like the media is probably going to paint this, as this more high-frequency trading strategies, hurting the markets here. But this is something that's always existed in the markets. I mean, a human being can do this too. They can put in a fake bid, try to manipulate what the quote's doing, and then turn around and hit, another bid if somebody steps ahead of them. So it isn't that this is just high-frequency traders doing this. I think we had some cases, a couple of years ago. I think it was Trillium, wasn't it? That they were doing something similar there with layering, and they're not necessarily a high frequency trading firm. I think it was human beings doing it, wasn't it?
Sure, yeah. I mean, and this is, I can't admit to having been there, but back on the floor in the '80s at the stock exchange, right? I mean, this is what went on, right? There was sort of an information advantage, and it was more people talking to people and sort of trying to hide their intentions, or maybe, make it look as if their intentions were different than they actually were. And the only difference today is we're doing it, rather than it taking a couple of minutes to play out, it takes a couple of microseconds to play out.
So it's all just happening faster.
Yeah, absolutely. This is nothing new. This even, goes back to the, when we talk about the worst overused term out there now, the flash crash. Right? Is quick, market sort of collapses and recoveries have been happening since there's been a market. It's just now that they take a couple of seconds, and it used to take a day or two, right?
We're on the line with Kevin McPartland. He's Chief Market Strategist at Greenwich Capital Markets. Kevin, you wrote an article, 15 for 15, top market structure trends to watch for 2015. We don't have time to go through all of them, obviously, but could you just highlight a couple of the important ones and tell us what direction it's going in?
Yeah, certainly. So one of the big things we keep an eye on that, it seems sort of very institutional, but it really does, I think, come all the way down to the end investor. Is the impact of new capital rules on the banks, right? So it's just cost the banks a lot more money to hold capital, to hold client positions, to facilitate trading with clients. So that's one of the big things that we're keeping an eye on, that we think will have a really big impact on the markets, going forward in the years ahead. I mean, there's of course it continues to be a big undertone of regulations really across the board. Everything that goes back through the FX fixing scandal that we've been working through towards, continued implementation of derivatives reform, whether it be in the U.S. and increasingly now in Europe as well. So we're gonna be keeping an eye on that. For the equity markets in particular, there's been a lot of talk about the sort of the unbundling, as it's called, of institutional investors paying for execution of their trades versus the research that they get from those brokers, and how that works. And I think last but not least, but probably most importantly, ongoing theme, right? There's been obviously interest rates have been near zero, and probably related volatility in the market has been relatively low, particularly in the equities market, which has sort of made it tough for brokers and for a lot of investors that have strategies that rely on the market moving, regardless of which direction it moves. So we're still sort of waiting for rates to rise, which hopefully will stir some activity in the markets and increase volatility, which broadly speaking, I think would be good for many people. We've seen some signs of volatility in FX. We've seen some signs, to a lesser extent, in the rates market, but equities is still looking nice and calm. So we're hoping that that might change in 2015, so the business can really get moving along again.
Yeah, and we've been in a 4 or 5 year bull market here now. Volatility is always lower as the markets are climbing, because volatility usually comes along with when fear starts. That's usually when you get people selling and you get a lot more volatility in the markets. But one other trend, and this is one of those myths that I like to debunk, is that they say high frequency trading adds to volatility, and I kind of at certain times that might be the case, but the majority of the time, Kevin, high frequency traders are providing a lot of liquidity. As you get more and more high frequency traders and more market makers, it thickens up the market and actually probably reduces volatility. So that overall trend, as the markets, become more automated and move into that, the overall trend here is that volatility has actually been on the decline. And I think a lot of that has to do with high frequency trading.
Yeah. I mean, I would argue that the speed of the market in general, in times of crisis, could lead to more volatility.
Yes.
This is what we just talked about a minute ago, right? People can react a lot faster than they could in the past.
Yeah.
But yeah, I agree with you, right? I mean, that's high frequency trading firms. Many of them act as market makers, and market makers, by definition, sort of take the lumps out of the marketplace. So I would agree with you there, absolutely.
It's just those other times where I think, there's a little bit of concern. I've always had a concern too, is that maybe too many market participants with similar strategies where you had a floor with a lot of different diverse, and there's similar strategies, but like you said, humans, can take a little bit of time to react. A high frequency trader can react in milliseconds, and they can take out a lot of bids in a hurry, and those bids don't have time to refresh themselves. So that's kind of why they put the circuit breakers in place, correct?
Yeah. Yeah, no, that's right. And so on the volatility point as well, interestingly, I was just looking this morning, is that the open interest in a lot of the VIX contracts has actually gotten pretty low. So whether it's a question of whether or not folks are choosing to not hedge against volatility as much right now because they don't think it's coming, or are they moving off and using different methods of doing that rather than those VIX futures. So I thought that was sort of an interesting data point that it's not completely clear what it means to the market, but it certainly keeps volatility both as an asset class and a major factor in investing in the spotlight.
Hey Kevin, looking at the S&P 500 futures, the E-mini? I mean, what percentage of the volume do you estimate is high frequency traded and automated trading?
That's a great question. I mean, at Greenwich, it's not something that we dig into too much. We spend a lot more of our time, with traditional end investors. But that said, I mean, if I had to stick my finger in the air, it has to be about half of the market, I would guess, at this point. And it's really changed the dynamic and increased liquidity. I think that's true. Said about E-minis, I think that's probably true in some of the rate futures as well. Eurodollar futures in particular, right, are very, very, very liquid. U.S. Treasury futures as well. So yeah, I would. It's probably roughly half without being too scientific about it.
So you're saying half high frequency trading or half automated?
Half probably high frequency, and again, what exactly high frequency means is a whole nother topic for a whole nother show.
That's the whole problem.
Probably not half high frequency.
Hard to define it. Like, we're at Bright Trading, we have a lot of people always calling us high frequency traders because we trade a lot. We do a lot of automated strategies. We don't consider ourselves high frequency traders because a lot of our strategies aren't dependent on speed. So, but there's no definition. So, sometimes I don't know if we're a high frequency trading firm or not, or if we fall into that. So Warren Buffett would probably look at us and say, "Oh yeah, you guys are high frequency traders for sure." So it's a tricky thing to figure out.
No, it is, and the technology has gotten to such an amazing point now that bits of technology 5 years ago that would cost so much that only the top tier of proprietary trading shops could afford to have that infrastructure. Now they're being sold off the shelf, and to some extent anybody can get their hands on them. And even for the real money investment firms, the table stakes for being in some of these markets has gotten to a point where microseconds is required for them as well, right? And they're sort of buy and hold strategies, and they're still executing much faster than they ever have before. So I think there used to be a huge dividing line between real money and HFT, and I'm not really sure that's so much the case anymore in terms of speed.
We've been on the line with Kevin McPartland, Principal of Market Structure and Technology at Greenwich Associates. He joins us about once a month or so to discuss market structure. Kevin, as always, thanks for coming on. Have a great trading day. Have a great weekend. We'll speak to you again soon.
Thanks. You too, guys. Take care. Have a good weekend.
Thanks, Kevin.